What's going to happen next? When's it going to be solved? Warren.
You picked me because you know I always have an opinion.
That's right.
I'm not terribly optimistic about a near-term solution for the trade war. I don't see what's in it for the PRC. Everyone knows that Trump is running against a fickle public and a clock ticking away ever steadily towards the coming election period. And when time is on your side in a negotiation, you don't rush to the finish line. I really don't see what's in it, as I said, for the PRC, unless Trump does what he has a record of doing, which is rebranding an existing trade arrangement, which is perhaps even less in the U.S.'s favor, and calling it a success, which is basically what he did with NAFTA and Canada and Mexico. So the only resolution I see to the trade war is one which basically benefits the Chinese. It'd be difficult for Trump to do that. So this could go on for some time, and as a result, I'd be very interested to see what Greg has to say about copper. But in the near term, I don't see copper going anywhere, basically because of the trade war.
But with an election on the horizon, you hear stories about businesses in sort of Middle America being hurt by higher prices of their raw materials and things like that, and then obviously how it translates into consumer goods. So he's got to balance that on one hand, but also not seeming weak.
You've summed it up, Leo.
That
is the conundrum. And so the question is, will he blink? And perhaps he will as we progress to get closer to the election. But it'll be a terrible climb down for him if he does blink.
But if anyone can say that black is white and white is black, this deal that I've done is a wonderful thing,
yep,
and his supporters will believe him whatever he says.
Absolutely.
He's the man for the job.
Absolutely. So that is a quite possible outcome, but I don't see that happening tomorrow. I see that happening 6 months from now.
Helen, what's your take on this?
Okay, given my limited knowledge about U.S. politics, but I think let me speak for most clients and Chinese people that I've been speaking to. It seems that they are quite positive about some progress going forward, and given that it seems that the president is a businessman, so that is good in the sense that as a businessman, you always wanted to negotiate, and China is ready to negotiate, right? So that's why we expect to see some deals ahead, even though there's a bumpy road ahead. And most importantly, we think the current commodity prices may have already priced in slowdown that is being affected by the U.S.-China trade war. So therefore, you can see whenever there's some positive development in the trade war, the commodity prices all go up. So that is why that's why we think the downside risk is limited, and basically we are monitoring the progress, but we do not think much as before, and we're looking for more of progress ahead.
How much has the trade war, do you think, affected the Chinese economy?
In terms of export, you can see the exports in September declined, and so that indirectly affects manufacturing. So what China government can do is to increase investment in infrastructure and continue to support construction. But still, the GDP growth, you believe or not, so it is declining. So so far the GDP growth is the lowest growth, right, in decades.
Sure.
So that you can see there's really some impact.
So they're keen to make a deal.
Sorry?
They're keen to make a deal.
They're keen to make a deal, but they also have some conditions. So they wanted to have, they have some principles that is a little bit difficult for them to give up. So so the point is, the bottom line, I think, is Chinese government already gave a low expectation about economic growth going forward, and they do not want to overstimulate the economy. So they have already said this, and a lot of investors have expected so. So therefore, they do not have much pressure to meet their promises, because they do not have a very big promises anyway, right? So therefore, I think they hope to get the deals that they want.
Greg, what's the McKinsey view?
How we see the world, if you're looking at the trade war, this is just compounded in a trend that has happened over the last 3-4 years anyway. It's highlighted structural issues between economies, and I think it's affected more the trade flows. But what we've seen, and if you look at our McKinsey executive survey that is sent out to hundreds of CEOs globally, over the last 10 quarters, we've seen a continued decline and pessimism, slow down to the world. And so this has come well before the trade war itself. But I think in itself, if you're speaking to our experts, the recession that is expected to hit the world is expected to be a shallow recession, unlike other issues that we saw in 2008 and before. And there's long-term optimism that there's still growth, that we'll see quantitative easing either through interest rates US or putting more QE into the Chinese economy. Chinese economy, as we've seen it, has continuously been propped up through this QE, typically at the beginning of the year, 7 consecutive years, that feeds into its infrastructure spend, with the other developments around the Road and Belt initiative, looking at growth within Southeast Asia, India. All these things I think will keep the metal markets driving going forward. I think the way we're looking at the markets at the moment is, yes, you've got this global economy that's changing its dynamics, but the attractiveness of economies or attractiveness of commodities lies in different spaces. We're looking at the structure of commodities, how the cost curves look. Are you on a steep cost curve, a shallow cost curve? Because within that, there's value to be captured. And so there's no such thing as a bad commodity in itself, but really good and bad projects. And so if you're very selective in what you're choosing, we think there's value to be captured throughout the metal space, irrespective of what's happening in the economy and the metal itself.
So you're essentially saying that the trade war has been almost a good thing to help the economy take a bit of air out of the bubble, to prevent a bad recession happening. Just let it sort of ease down a little bit.
Well, I think we've come from the highs of 2011, where many of the large companies and smaller companies cleared their balance sheets, restructured themselves, became lean again. And so we're seeing companies that are efficient in their operating models, are looking at technology to improve productivity, looking at ways to grow their resources through advanced analytics, and this bodes well. When we've looked at the numbers, those companies that are in the top quartile of either productivity improvements or on the growth aspect in increasing their reserve base have significantly outperformed their peers, and in tight markets. So this is just, whether there's a recession or not, we think there's opportunity going forward for those companies that are willing to make those big moves.
Still good companies out there, and the fears of the trade war has actually caused people to be more efficient in the way that they're working.
Absolutely.
I think no one really likes the trade war, and no one, expected this to happen. And because the global economy is already facing slowing down, and basically there's not much room to stimulate the economy because of the interest rate is already low. So and also basically we think this trade war basically slowed a lot of things such as development in development in battery and electric vehicles, and because if the economy is very good, and the government will be able to push ahead, the new policies, but now they have to grapple with the economic slowdown, and that is what is happening in China. So therefore, for example, in this space, you can see the lithium prices going down, and actually a lot of good companies actually are suffering. So, but since the trade war has already happened, and that is, as Gregory mentioned, a lot of companies have to grapple with these difficulties, and the good projects with good management will eventually survive. So that is the reality everyone has to face.
So you're saying that the cut in subsidies for EVs, you're linking that to the trade war?
Yeah, somehow, for example, because of if you look at the automobile sector in China, and suddenly there's a substantial slowdown because purchase of an automobile is related to consumption sentiment, and this slowdown started in May last year when the trade war started. And just look at how it affect the total sales of automobile in China, and so far the electric vehicle sales also start to slowing down. Right, so that is certainly. Then again, this is related to your commodities, usage, in automobile, aluminum, copper to some extent, and as well as the steel. Yeah.
But what opportunities is the trade war creating? Do we see any opportunities out there?
It's a buying opportunity. That's what it's created. Everything's for sale. Let me make a couple of points. I agree completely with Greg's original point, which is at the end of the day, it's all about the quality of the company, not necessarily the commodity. So whenever I make an investment, it has everything to do with the ore body. As soon as someone comes into my office and they say, what are you looking for? What are you looking for in an investment? It's a very, very simple question. It's all about the ore body. I'm commodity agnostic. I'll look at any commodity. I just want the best bloody deposit in the world. And if it's a great ore body, I don't care what the commodity is. So at the end of the day, make your investment decisions on the basis of the quality of the ore body. Forget about the commodity. That said, in terms of timing, sometimes commodities are in favor, sometimes they're out of favor. Right now, a whole raft of commodities are out of favor, and that usually tends to mean valuations are down, and it's a good time to be buying. And so that helps. But you shouldn't base your investment decision on whether you think the price of the commodity is going to increase or not. As the saying goes, that's a hope, it's not a strategy. And your investment strategy should be on the quality of the project itself. And of course, the management team and balance sheet and geopolitical risk and all those other things that go into that. So that's the first point. And to answer your question, Leo, the trade war, which we all hope is a temporary situation, is therefore by definition a buying opportunity. Your next question is, okay, Warren, understand all that. Now, what commodities do you think are going up and which ones aren't? Which is probably your next question for all of us.
That's correct.
I think it's a question of timing. I think everyone in this room is bullish on the mining sector in the medium to long term. And that can't help but be reinforced by the fact that this industry, certainly since 2008, 2009, has really struggled in terms of raising capital, and really struggled in terms of capital applied to both exploration and to mine development. That's all a great thing for longer-term investors, because we all know the mines that we'll need in the next decade haven't been found and haven't been built. So that we know in the medium to longer term, prices of everything are going to be higher. So, great time to buy now for that move in the future. The question is, at what point in the future is everything going to move? And I'm in no rush to make investments, because I don't see anything moving in the next 6 months, maybe a year. I shouldn't say anything, there are obviously exceptions, but generally speaking, we're going to continue in this malaise probably for another year. But the decade of 2020 is going to be exceptionally good for the mining industry in general.
What's going to move first?
Well, if you're asking me what I think is going to happen in the next 2 quarters, barring a total acquiescence by Mr. Trump on the trade front, I don't see bulks being a good place. I don't see base metals being a good place. I arguably think that gold has had its move, and it's in a nice little trading range, so it's not moving. You know I'm a uranium bull, so I do think in the next couple of quarters we'll probably have a 20% move in uranium, which in percentage terms is reasonably significant. The only thing preventing that, and I reiterate a conversation I had with your next presenter, CGN, who I had a meeting with yesterday, and I thought they summed it up quite nicely. They said, look, the problem with uranium right now is not a supply-demand issue, because the market is in extreme deficit. The problem is simply one of sentiment. The uranium is being thrown in with copper and iron ore and met coal and zinc, and no one likes the mining sector. So even a commodity, and one might argue it's not a commodity, but even an input that is in quite extreme supply deficit on an annual basis, the price is falling, not going up. And that's probably more a sentiment issue than it is a supply-demand issue. And I thought that was a very good argument, because I come at it very much with a supply-demand perspective, and I was saying we need to do more on supply. We need to get Kazatomprom to start cutting production more. Cameco is doing more than their fair share. We need the 10,000-pound gorilla to cut back. But CGN's point was, look, we're already in deficit. What more do you want? Valid point. So, I think uranium has a hope. Certainly, if not in the next quarter or two, certainly for 2020. But going beyond that, hard-pressed to find a metal that isn't going to be higher.
Greg?
I'd probably add to the fact that if there is a truce trade deal is made between China and US, we're likely to see a weakening of the US dollar back to levels that we saw 12, 18 months ago. Currently, we're sitting at an extremely strong dollar at about 98 on the Bloomberg Dollar Index, where competitively, I think they would be between about 87 and 93. That automatically holding your costs in local terms constant is going to push up your base and push up prices higher. So back to your point, Warren, with that, you're naturally going to see prices across the board moving higher. I would push and say, I think if I'm looking at a portfolio, it depends on how your strategy to structure it becomes important. And I think there's 2 themes that we see coming through broadly. One is looking at how BHP are looking at the market. Over the last 15 years, they've really structured their portfolio, narrowed it down to a couple of key markets that are oligopolies that they can have control over. They're moving more into potash for that stable cash flow. They've got copper, iron ore, which has decent margins on the cost curve, and that going forward they'll continue to make their returns as a large diversified. On the other hand, you've got players like Glencore, which are moving into more niche markets. They've done well on the cobalt side, cornering that element of the market, taking advantage of potential fly-ups, and similarly on their met coal portfolio, highly attractive given the high quality nature of the assets and the pull from Chinese buyers in a environmentally sensitive world that we live in at the moment. So I would look at it and say, depending on your portfolio, there are different ways in which you can structure and take advantage of whichever tailwinds are heading your way.
And currencies really playing a big part there. So we've had gold in record highs in the Aussie dollar and the British pound over the last few years, but the US dollar very high, so commodity prices kind of look lower than they possibly are. Should investors? I mean, obviously investors should be looking at how the costs in the country that the stuff is being produced, and really consider the currencies beyond just looking at the dollar value, the US dollar value. You see what I mean?
Absolutely. Understanding the market dynamics, domestically where these costs are generated is important. I think what you're going to see is two things. One, you've got this FX effect, which you can't control, and anybody who says they can understand where it's going to move and the timing thereof, I'm going to put my money with them, because I haven't seen anybody to date who can do that well. But what we do see is that companies are looking into more emerging markets for the next big project. We've seen Resolution, probably on the copper side, is the next big one that's just been given approval in the US. But beyond that, there's a very tight pipeline. And so players, even big players like BHP, have come out and said that they are willing to move into areas like Africa, which they've historically stayed away. That's going to push up costs because you're working in more remote locations. You're moving away from the epicenter. And so your players on the left-hand side who've control their costs versus these ones that are moving in on the right-hand side is going to push up prices, and there's value to be captured and gained by that disparity in the market.
While we've got you here, we should probably ask you about South Africa. Once, I guess, still a major mining centre, but has some issues. How's that shaping up, given that we have our conference in Cape Town in February, in case anyone wants to join?
So I think tough market. We see a number of structural issues, particularly around labour and productivity, with strike action occurring multiple occasions through any given year. Players trying to figure out how to manage that dynamic. That said, the weakening of the rand, particularly as we have instability within the political system, has maintained and kept players afloat, albeit at the margin. I would say many investors who are looking at the South African market are really looking for stability in the policy regime of the government to understand where they're going to be 10, 20 years from now. The big concern is, if you invest now, will you still have the lease and the right to mine going forward?
Helen, what commodities are your clients asking you for? What do they like?
Right. So given the backdrop that we discussed, and so basically my view is that there's some progress in the trade war next year, and China will have a lot of stimulus program, and also I think they definitely have a lot of room to do monetary easing, but so far they are reluctant to to do more. And also the US dollar, as we just discussed, we also think there's a chance for the US dollar to go down. So basically, we definitely see a lot of buy opportunities next year for in the commodity space. And especially we wanted to highlight, say, for example, say copper. And the reason why the copper has been trading in the tight range is because of concern about slowdown in China, and now suddenly we have this supply issue in Chile, and it seems that it is not something that can be solved quite easily, and Chile accounts for a third of global copper supplies. And if this social movement continues, and as what happened here in Hong Kong, then certainly that is a big supply issues that may certainly drive the copper prices higher. And talking about the demand for copper in China, so far the power. The demand for the copper demand from power sector is quite weak, but we start to see improvement from home appliances sector as government continue to provide more support for consumption, and also we start to look at some improvement in. In overall economy, for example, that we see the production of machinery is increasing, and so that is overall, I think, it may help offset the slowdown in the power sector. So, I think copper is something that we wanted to focus on next year, and as well as bulk. Rather, we think we expect to see steel price to go up, bauxite prices to go up next year.
Interesting. Is there anything our panelists would avoid in 2020? You seem quite positive. You all seem quite positive that things are going to go up. Anything any stinkers out there?
Well, I think I would, as I say, it's a buying opportunity, but I'm not bullish, as I said, that 2020 is going to be a great year. So, to the extent that you're looking for a commodity run in 2020, I think everything is to be avoided, virtually. I mean, as I say, how do you get, unless there's a solution to the trade war in the near term, I don't see how you get excited about base metals. I don't see how you get excited about bulks. Obviously, the whole EV revolution is awash in supply of cobalt and lithium and graphite, and so we got a long-term problem there.
I noticed you didn't mention nickel in that list.
Yeah, and nickel I can almost not even bother with because, I'm a huge... I know a lot about nickel. A lot of my history is involved in taking big nickel companies public and doing nickel M&A, so I know a lot about nickel, and I love it as a metal, but one cannot base an investment decision on wondering what the Indonesian government is going to do between coffee and lunch tomorrow. I have no insight into that. And I would generally be biased to think that whatever they do isn't going to be good for me. So it's almost an uninvestable sector until the industry dynamics get sorted out between China, the Philippines, and Indonesia. That nickel's a real tough one from an investment perspective, notwithstanding this short-term little bubble we've had. But let me just backtrack 1 minute in terms of, I think it's worthwhile making a point about currency. We're all a little bit biased about investing in weak currency countries, and that's all understandable because theoretically your variable cost in US dollars will diminish because the US dollar is worth more and the local currency is worth less. But at the end of the day, investors who provide me with capital to invest on their behalf provide me with US dollars, and they want US dollars back. Dollar stock, say a gold stock, whose margins are expanding in Australian dollar terms, but at the end of the day, when we sell that stock, I have to translate it into US dollars, give it back to the investor, and the investor measures his return not on how much the Aussie dollar declined, but on how many US dollars he gets back. And so, likewise, if the local currency costs are going down because the local currency is going down, by definition, the local currency is going down, and so forth. Therefore, the stock price in US dollar terms is going down. So let's not think that a weak currency is the solution to investment problems. If you're being measured by your return in a stable currency, which for better or worse these days is the US dollars, you have to measure your success in terms of returning capital to yourself in a stable currency. I don't care how many Aussie dollars I have if they're worth 30 cents 10 years from now. That's not doing any of us any good. So I think that point needed to be made.
Unless you're a streamer, unless you're doing streaming or something like that, and you're getting paid in the
streaming,
commodity,
same thing. I want
US dollars.
What's the US dollar price of my income, not my Aussie dollar price.
Great.
I'd just like to jump in and talk about nickel. I think what we're going to see going forward is a bifurcation of the market as investors, as the industry becomes smarter. And what I mean by that is looking at nickel class 1 and class 2, and we're pretty much at a balanced stage between both of those sectors. But if you look going forward, there's this massive oversupply on the class 2 side, with the production from Indonesia expected to come online and fill that space. But then on the converse, if you're looking at class 1, which is your high purity nickel metal that's used for EV battery materials, the deficit starts to show going forward. So from a class 2 point of view, I stay away significantly looking at the nickel pig iron. But on the class 1, there I think the opportunity lies, particularly in assets that are of quality. I think what the large majors are waiting for is that inflection and early signposts that this is what's going to happen and when we're going to see scale from the EV side. But I think it's on the horizon.
We have Linda Zhang from Wood Mackenzie in the audience here. She'll be talking on nickel later, so please do come back for that to hear Wood Mackenzie's opinion on that. Do we have any questions from the audience? We've got about 1 minute, 45 seconds left. Any questions? Stick up a hand if you want to ask our panel. If not, we've been talking about sort of some of the things that have been shaking up the industry. Helen, I wanted to ask you, these protests in Hong Kong, to what extent have they impacted Hong Kong as a sort of financial centre and the business being done?
Right, and certainly I think it has affected a lot of retail industries here in Hong Kong, but to some extent, so far the financial industry in Hong Kong is not being affected too much because eventually, just look at this event and the upcoming events to be held in Hong Kong. A lot of investors are still coming to Hong Kong to looking for deals from China, and the Chinese companies are still come to Hong Kong and to meet investors. So basically, I think Hong Kong remains to be the gateway for China. I'm very impressed for the pictures that you put it behind. So that is how amazing Hong Kong is. So we should have some confidence in Hong Kong in the future.
There we go. Fantastic. Well, we've run out of time there, but if you want to grab our panelists and ask them any more questions, please do grab them outside over a coffee. But thank you very much. Excellent way to start the day. Thank you.